it's been a little bit since I read anything from Simon Black at sovereignman.com. Not that that's a bad thing or anything. He's, pretty sharp guy, has some interesting things to say in his little newsletters. And when I find something interesting from him, I tend to do a video naturally. Sovereign Valley Farm, Chile. A few days ago, Charles Schwab, and this is, first of all, headline. The last time this happened, the market crashed. Remember the chart I was showing you a little while ago? Consumer confidence absolutely skyrocketing. Consumer confidence massively up again. Everybody's happy. The house flipping. Flip houses, getting the house flipping. But the market's at an all-time high again. No, forget it. House flip. Okay. The last time that happened, market crashed. And the last time what he's about to talk about, the market crashed. And that's why I want to talk about this. A few days ago, Charles Schwab, the investment brokerage firm, announced that the number of new brokerage accounts soared 44% during the first quarter of 2017. More specifically, Schwab stated that individual investors are opening up stock trading accounts at the fastest pace the company has seen in 17 years. She's only 17. 17. Anyone remember what happened 17 years ago? Oh, that's right. The dot-com bubble burst. After years of unbelievable gains in the 1990s, the NASDAQ Composite Index peaked at 5,132 on March 10th, 2000. Simultaneously, during the first quarter of 2000, investors were rushing to open new brokerage accounts, invest their savings into the stock market. The NASDAQ Composite subsequently fell nearly 80% over the next 2.5 years, wiping out trillions of dollars of wealth from retail investors. The last phase of any bubble is almost invariably the euphoric shopping spree of an irrational public. No. I got to rephrase that one. The last phase of any bubble is almost invariably the euphoric shopping spree of an irrational, moronic public that buys stocks, real estate, flip them, man, Canada, flip them, etc. at record highs. Oh, real estate's at record high. Markets, record highs. Foolishly believing that prices will just keep rising indefinitely. That's what happened in 2000. And that's what seems to be happening today. Investors are once again clamoring to buy expensive, popular stocks at price levels never before seen in the history of the stock market. Again, this is happening. These morons are opening accounts left and right. Yes, I want to play this game. How many of these people are going to be leveraged and get margin calls and it's going to be wiped out? And they're all doing this with the insanity. Snapchat, not profitable. Uber, still not profitable. 10 years of Tesla cars haven't been profitable ever. In the last 2 years, worst on the record for them. But the company is worth tens of billions of dollars. Oh, and Twitter's another one. Again, if you saw this, you would say, what the hell are these people doing? But then again, you would also say, but this has been going on for quite a while. I mean, in all honesty, after the crash of 08 and 09, Dow Jones hit 6,000 something or whatever it was. It's almost tripled. Actually, quadrupled, 6,000. Well, it was closer to 7, so let's be real. 7 times 3 is 21,000. We're there practically, right? We're there. You're telling me from 2009, it has tripled. Again, after 09, so 9 to, we're talking 8 years, roughly. 8 years. 2008, add 10 years to 2018, but we're not. We're talking about 2009, etc. Roughly 8 years. And a market has tripled. I want you to think about how absurd that is. In 8 years, a stock market, which again is a bunch of stocks inside the Dow and S&P, have tripled. And they kept going. When they shouldn't go up, they've gone up. When there's no reason to go up, they go up more. That's what Lindsey Williams said was the suckers rally. They're going to sucker all of you. Every last sucker they're going to pull in before they pull the rug out from underneath you, in which they all stand to make even more money. Yet the people don't know. It was 2000. How long ago? It wasn't that long ago. .com crash. 2008 and 9. Again, 8 years ago. 7, 8 years ago. That's all right. We have memory loss issues. We're all on pharmaceuticals in this country more than any other country, and drugs and everything else. We don't remember. All I know is I'm sitting here watching this thing go, I got to get in and get some action. And like I said, when you finally figure out I've had enough, I've been watching this forever, I can't just sit on the sidelines anymore. This is absurd. I got to get in. That's when everybody else is thinking the same thing. But you don't know that. You think it's just you. Maybe you and a buddy at work talk about it, but nobody else at work. So certainly not a lot of people are thinking the same thing we are, when in reality they are. We're going to open a bunch of Charles Schwab. And so if that's Charles Schwab, what about these other brokerages? How did they do in the first quarter? Unbelievable. Company valuations are sky high. At 26.44, the S&P 500's price to earnings ratio is the highest ever, except for two occasions. The 2008 crash and the 2000 crash. Again, title of this, the last time this happened, the market crashed. Oh, wait a minute. Here's another one. At 28.93, the Shiller price earnings ratio, which looks at company valuations over a longer term, 10-year period and adjusts for inflation, is at the highest level ever, except two occasions. The year 2000 and the 1929 epic stock market crash. Yeah, that's right. Price to sales ratios are near the highest levels in at least 50 years. And you know something? Let me open this. I got to open another email. But first, someone's ringing the door, so stand by 1 second as I pause this. All right, so I got to open my other email because someone had a nice little comment for me. If I can find this real quick. Not that one. Here it is. Actually, this isn't it. But I'm gonna read this anyway because it's something else. In San Luis Obispo, California, the mortgage debt to income ratio is a staggering 2,014%. Market Watch. This city has the most heavily indebted homeowners in America. Again, remember the video I did a while back? What the hell are you doing in California? Get the hell out of there. Remember that one? Just, if not, I'm going to go check that back out again. So here's the one I actually want to read. Speaking of absurd prices. A 1,000 square foot, 3-bedroom bungalow worth $200K in 2012, he says, just sold, this is Ontario, of course, Ontario, just sold for $565,000 last week after a bidding war broke out over and above the asking price of $420,000. Could you imagine saying, man, we got this thing for $200K, we're going to list it for double that amount plus an additional $20K, right? $200K? $400K is double. Add an additional $20 for a bonus. We're going to sell this baby for more than double. Oh my God, a bidding war broke out, and the price is now $565,000. Could you imagine the insanity? This is what I'm reading you, essentially. This is what I'm reading you. The insanity everywhere. And the people, what they all saying about separating a fool from his money, his or her money, right? We got to be fair for sure. Oh man. So let me open up back where I was. Price to sales ratios are near the highest levels in at least 50 years. Price to book ratios haven't been at this level since the 2008 crash, and the stock market cap to GDP ratio is the highest since the 2000 crash. If you don't understand those terms, I would highly encourage you to read this book, which he links. And I'm just going to tell you what it is. The Intelligent Investor, revised edition, Collins Business Essentials. It's on Amazon. 4.5 stars on here. 1,453 customer reviews. You can download it for, wow, Kindle. Kindle is $16.49. What? Hardcover, $12.99. Paperback, $5.54. Audio CD from $7.86. Wow. Anyways, The Intelligent Investor, revised edition. But I don't think you really need to know what these definitions and things mean. You already know based off of what I'm telling you every day. You don't have to get to down to pull a magnifying glass out and figure out what this what's the actual cap to GDP. Doesn't matter. Billionaire investor Paul Tudor Jones described these expensive stock market valuations as terrifying earlier this month at a closed-door asset management conference hosted by none other than Vampire Squid, Goldman Sachs. Yet, for some reason, individual retail investors still believe that stock prices will continue to rise. According to Yale University Stock Market Confidence Index, for example, over 90% of individual investors believe that the stock market will rise in the next 12 months. This sentiment isn't actually based on any data. It's simply how people feel. These are classic bubble conditions: record high prices, unsustainable valuations, baseless euphoria, and a surge in activity from retail investors. In fairness, it's possible that corporate profits surge by unimaginable rates. This would bring valuations back to reality, but that's unlikely. Corporate profits are more or less tethered to the overall economy. If GDP growth is flat, corporate profits will be flat. Real GDP growth in the U.S. basically went flat in 2016 at just 1.6%. And the Federal Reserve Bank of Atlanta estimates that the U.S. economy grew a pitiful 0.5% annualized rate in the first quarter of 2017. Consumer spending, the mainstay of the U.S. economy, slumped in the first 3 months of this year. But yet consumer confidence is massively high. Isn't that weird? Plus, interest rates are starting to rise, which is increasing borrowing costs for both businesses and individuals. Given such anemic conditions, it seems a risk to bet everything on a sudden shock and awe surge in corporate profits. So we're right back where we started. An overvalued market exhibiting classic signs of a bubble. I'm not suggesting that some major crash is imminent. It's entirely possible that this bubble can get even bigger. The stock market might rise another 10, 20% or more. But it's also possible we'll see a drop of 40% or higher from these levels. Remember, the NASDAQ composite fell 78% from its peak in the year 2000. Rational individuals always consider their downside first. Fear of loss should be far greater than the fear of missing out. And again, while this euphoria and these idiots are flooding into the market, the elite, the Pilgrims Society members, which I've got a video to do after this regarding that. If you've never heard of the Pilgrim Society, it is the elite's secret society of all secret societies. It is the secret society of all secret societies. Every banker, railroad, oil cartel is currently or has been in this society. And I got a short video to do with an unbelievably massive PDF file uploaded to a server that is going to blow your mind if you were to download this and take probably 2 hours to read it, thanks to a guy that sent it to me in email who's done incredible work putting the pieces together, following the trail, who belonged to this, family married into that family, sister married that guy, blah, 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 blah. And he's come to the conclusion also, every single financial problem we've ever had in the history of this country has all been orchestrated by these people. Nothing has ever been an accident. And they make profit no matter what happens. When everything crashes, they're extremely profitable. When everything goes back up, they're extremely profitable. Again, while you're flooding into there, they're going to be getting out. And then the market is going to absolutely crash. And all the wealth that they just stole from you, everybody, the whole world, when the markets crash, they'll be shorting it on the way down. But they already got out of their stock, all the stocks and crap they were in, and now we're sitting back with an enormous amount of money. And then the market crashes. 21,000 Dow crashed down to 14,000 today. And only they know when to get back in because they know exactly what they're doing. They're causing it. And if it's going down to 5,000 Dow, they're not going to buy in it at 14,000. No, they're going to let it go, let it go. Oh, now it's 5,000. All right, now let's take all that profit we made when it was 21,000. And we shorted it going down. Now we're going to buy back into it. And then when it goes back up, again, this is just a cycle. Rinse and repeat, do it again. Quite simply, if the reward isn't worth the risk, don't do it. Find something else or do nothing and simply wait on the sidelines. The universe of options is a lot bigger than simply U.S. stocks, and there's an abundance of great opportunity outside of the mainstream. Lately, I've been involved in a number of secured lending deals where I'm able to earn between 10 to 12% per year with almost zero risk. This strikes me as a great alternative to the stock market. I'd rather make a fixed 10% with minimal risk than potentially make 15 or 20% but risk a 50% loss. I've also been buying cash-producing royalties, which in my view is one of the most undervalued asset classes in the world. More on that another time. Bottom line, there is no sense in taking on enormous risk to make a few bucks. Again, this is sovereignman.com. Simon Black. So, I think I'm going to open up a Charles Schwab account and not a chance in hell. Take care.